Welcome to episode 226 of The Numbers Game. I'm Jace. I'm here with Nick and Marty. Nick, what's happening, mate? You got a problem with cars or what?
I parked my little car down in the driveway this morning, undercover car park. And every time I walk past Marty's four-wheel drive, I think, geez, I wonder what he paid for that thing.
Hang on. Little car, you said?
I walk past and you know what? The only
Little
thing that stops me saying something is I think he's got a big commute into work. He spends a lot of time in the car. He needs to be comfortable and he needs to be safe. Loves his podcast, so he needs a good stereo system. And I'm like, you know what? That guy, he's
you blokes.
anyone deserves a nice car. It's Marty Vids driving in all day.
Jason enters in with the wheel and goes straight to me as the oldest person. Now I can't even drive a car without comfort. I tell you what, you blokes.
So
Little
anyway,
car.
look. So Marty, thanks for triggering this in me. But the reality is, car loans are destroying people's wealth, whether by choice or not. I think they are, and I think I would like to unpack that and just put some numbers around car loans and what's the trade-off, and if car loans are something that you have always had and you like to have because you like a good car and you like a bit more cash in the bank, you don't want to use your capital to buy a car, just understanding the ramifications of that and what else could you do with that money if you weren't.
It's a big statement, Nick, and I'm just going to preface this by saying anything that you've said on the podcast has generally happened and caused, shockwaves around the country. So if you say there's a problem with people going out and financing and buying new cars and it's destroying our wealth, I just worry about the new car market. So just going to register that and just place that there. But I'm actually very interested as someone who has, for the last 10, 15 years has rolled, a novated lease or, high purchase into a new car. You've got my attention and I'd love to know a bit more about it.
Well, yeah, and just to double down, big, bold move for me because we do have an asset finance division which does finance cars. So for me to be talking about this, I'm obviously passionate and I feel that it is significant. And to be completely transparent, I'm someone who has always had car loans. 100%, that's me. But I think what I've realised, particularly in the last car, I made a small change on the last car where for me it's now about the balance of, okay, a good car, reliable car also, and I'm personally okay with the repayment, but nowhere near what I used to be okay with. So it's just getting that balance right, and everyone's going to be different, but I thought it'd be good to unpack the different options and the numbers, just so people understand as I said, the ramifications of having car loans. So, Jace, you said you roll over a car loan every few years?
January just gone was the first time I've ever financed the balloon instead of trading, selling it to pay the balloon off and then financing into a new car with, hopefully usually there's a little bit of a buffer, because what the car's worth is usually bigger than the balloon. And I see that as my healthy little deposit on a new treat, especially, when there's that psychology of as a business owner and, I drive around a lot from office to office or to clients. So, there's a certain portion that's tax deductible and, you can tell yourself a story that justifies having the new wheels and, as you said, reliable and an image and whatnot. But it was the first time ever that Casey and I had the conversation, and focusing on buying a property is a bigger focus for us this year than, upgrading the new wheels and having even if it was the same monthly amount coming out to then increase the amount of debt that's sat on a vehicle. And we did the assessment going, we have a comfortable car. It's beautiful, gets us from A to B. It might be a 2020 or a 2021, 4 or 5 years old, whatever it ends up being at the moment. But we're happy. And it went, it was the first time I ever haven't rolled it over into a brand new car with a new lease.
Well, it's pretty much my story. So my car lease, the 5-year term, ends in November. And I just got thinking about it the other day because it's the longest in a long time I've kept a car, usually 3 to 4 years, then I get rid of it. This one I've kept for 5 years. And I think COVID has been a contributor to that. Less Ks on the car, other values, The other thing is, I got it at the start of COVID, so rates were pretty cheap. So to roll into a new car loan now, I'm paying double the interest. This is the first time in a long time I've gone the whole 5 years, and the balloon payment, I looked at it the other day and I went, shit, I've got that money. I could actually pay that out and have a car with no debt. Like, how long has it been since I've done that? And I'm pretty happy with the car. The only thing that I'm thinking about is, well, it's probably at the time when things are going to start to go wrong. So, I will buy a new car, but it'll be not like it used to be. Yeah, I see exactly what you're saying there, because I've gone through the same thought process myself. But I think particularly with business owners, and you'll know this being in your industry, but every three or 4 years, no, you just roll into a new lease. Your lease, it's tax deductible. These are the things. But we go back to the what I always say about tax. It's only deductible. It's deductible, but you only get half of it back, and that's only if you're in the top tax bracket. Would you rather not have the dollar or have the dollar and give half of it back? I know what I'd rather. I'd rather have the dollar than pay it and only get half of it back. So I thought about this, and the reason not having a car loan really resonates with me is because I'm not far away from buying a new house. I've got a daughter now, so hopefully we'll have another child as well at some stage. So we're thinking bigger house. And I'm thinking bigger house, and I'm looking at the repayments on a bigger house, and I'm thinking, geez, something might need to go, such as a car loan. So I thought, I'll just look at some numbers, and hopefully I've got some numbers that everyone can relate to. I know this is definitely something that we would see in our mortgage business all the time, or a typical kind of scenario. And Marty, I might get you to chime in here, because I think this is in your wheelhouse. But a typical client for Innovate. So young couple of kids, looking to buy a new house, combined earnings of $240K per annum. So an average of 120 each. That's pretty normal these days. If you've got two professionals, or even a trade and a professional. Quite typically, you'll see one car with 60,000 owed on it. I don't want to stereotype here, but that could be the tradie with a Hilux. The base model Hilux at 60.
That's just what's left on it after they bought it for 90. But yeah, go on.
60,000, 1,173 a month in repayments, pretty standard. Then you've got the more zip around car. It might be a little Camry or something that the family uses. CX-7, there you go. $40,000 car with a $782 per month car loan. So that's pretty standard. Most couples these days have two car loans. They've both got a decent car each. That couple on 120K per annum, two children, which is why they need the two cars. One's got to go to basketball, one's got to go to footy, all that kind of stuff. Their borrowing capacity in a home loan is $927,000. So they can, assuming they've got a deposit of 10% or $100,000, they can probably spend about $1 million on a house. If they were to do that, you add their car loan repayments to their mortgage, their monthly repayments in that household are $7,754 per month. You with me?
Yep.
Now, hypothetically, those car loans were gone, and let's assume they had the money to clear the car loans. I get the fact that you've got to have the money to buy the cars. I'm not that naive, but let's assume they didn't have car loans, so those two monthly repayments were gone. So their borrowing capacity would go to $1.162 million, which is a $235,000 difference on their prior borrowing capacity. So without the car loans, they can hypothetically purchase for another $230 to $250K on their house. So they can buy a better house. Their repayments on that house are $7,265 a month. So if they've had the ability to pay for the car loans are over 5 years, so obviously the repayments are quite high. You've got to get that money back to the funder pretty quick because they're a depreciating asset. But hypothetically, if you did have the cash to buy cars, you would be $100 a week better off in cash flow. You'd have a house that was worth $235K more, and generally a house that's better for what you need. But this is the big thing, and this is where I wanted to get your input, Marty, because this is the kind of stuff you like, and I reckon. And of course, I was joking about your car. You've paid your car off, and you're one of the few people I know that doesn't have a car loan, and you do have a decent car. But if that asset was worth $235K more, let's say you assumed the property market grows at 5% per annum year on year as an average, and historically you can go back, and that is the number. By spending an extra 235K on that house, fast forward 30 years, and you're another $1,050 in the black. So basically, you've turned that 235K extra that you borrowed into $1 million in assets. Now, on the flip side, if you had those cars, Jace, what happens to the value of cars?
Depreciate. They go
depreciate.
down.
So that was a really basic example. And I know most people would be going, oh, that's great, but how do you buy a car? Who's got 50 grand laying around to buy a car? I totally get that. But one of the things that we see a lot, and you, again, I'll talk to you, Jace, because you've got an accounting business and a lot of trades. You will see people with the money to buy a car, 100%, see it all the time. But they would rather keep the money in an offset. They'd rather keep the money for a rainy day. You can buy a pretty decent car these days for 50 or 60 grand with a 5-year warranty on it, which means I don't have to spend the money for 5 years, but people want to buy the car that's worth 100 grand. They want to buy the Ford Raptor. They don't want to buy the Nissan. So there's always an option. I just think people don't consider it. They just think about what car they want, and they look at the repayment and they think, oh, I can afford that, so I'm going to buy that car that I want. Versus, well, could I get a car that was 30 or 40 grand cheaper with a 5-year warranty and ride it out? And when I get more money in the bank, I'm going to upgrade to the next car. So I just, again, I don't think people have these conversations with themselves. They look at what they want. Does it fit in the budget? Yes. Without thinking, well, what's the flip side of that? What if I didn't do that? What could the house purchase look like? And what impact is it having on my long-term wealth? But Marty, you've probably already done these numbers. I can see you smirking like, oh, this is old news.
Oh, my heart is swelling with pride, Grasshopper. It is what you're saying here is like, again, there's decision points where you go, like, what do I actually need? And it changes your perspective when you don't think about having a loan on your car. You make different decisions. And it's actually, and then you see the actual price of that car in real time. Like you said, it's a depreciating asset that's falling in value when you could be putting it into something that's growing in value. And fundamentally, that's the right thing to do. Emotionally, that can be a very different thing, as we know. And I've certainly been on the other side of that fence as well in my 30s and my late 20s. And one of the commitments I made to myself is that if I'm to do this, if I'm to buy a car, it's going to be with no debt. But what do I have to do differently in order to get into that position? And then even that decision point is really interesting, because you go, is it worth moving an asset or selling an asset in order to get the car? And in most situations, it's not, right? But it shifts your whole perspective. You go, oh, my business is too valuable. I don't want to sell it for a car. Or that piece of land's too valuable. That's appreciating in value. I'm not going to sell that for a car. So it's like, so to have the money there and to create the money in order to make the purchase is a very, very powerful way of thinking in wealth creation. And I think that's the difference. People don't really understand, because they just want the car, as to what the impact is on those repayments going towards that car that's falling in value, as opposed to going to something that's building in value. And it just makes different decisions. Like, we had a situation where Cole crashed her RAV, and it was worth probably about 12 grand at the time. It was probably about 7 years old. And we could have upgraded a car if we wanted to, or there was this opportunity where we had this person that had a car that was available that was about the same price. So didn't look as good, didn't feel as good, but it was the right decision. So we made that decision. So, and she drives, my car anyway. So fundamentally, it's just a stronger decision. But that only comes from wisdom of burning money in the wrong areas when you're younger as well, and understanding the ramifications of that. So I'm glad that Nick's brought this up, because now my decisions are based on fundamental, will this put us in a better position or not, fundamentally. Now, if you've got the money there, great, buy the car if it's cash, and that's where you think it's best for that money to go. But even when you say that, you go, it makes you think about what the alternatives are. And I think that's really important.
Well, and even looking at those numbers, right? I mean, if you told someone they shouldn't buy the new car, often it's like, oh, but why not? It's not going to make that big of a deal. But $1 million, when you get to retirement age, to have an extra $1 million tax-free tied up in your main residence, your primary place of residence, like that's pretty bloody enticing to go, well, if I make some better decisions around the car that I drive now, how much better life will I have later to forego some of the fancy bells and whistles today?
And Jace, I can't tell you how many times I've seen business owners, they got tax debt. They're heavily leveraged in their business. And then they want to buy a Benz worth 150 grand that they can't afford. Why? You go, fair enough, it looks a certain way and I'm a business owner and that's all great. That's the story. But I'm going, you're throwing bad money after bad money. And it's just, I always come back to Buffett. It's like he drives the same car for 10 years. He's probably the other extreme. And it's like, he's been in the same house for 50 years. Now, I'm not saying that's right either. That's the other extreme. But the fundamentals around that is actually very, very smart.
Yeah, I think it's a combination of, Aussie culture, like the psychology around buying the fancy new things, marketing, what we see on every time we turn the TV on between the ads at the footy, it is the Ford Raptor Ranger doing some cool jump on, some Outback thing going, so it's all this subliminal messaging around having the nice things and being successful and looking and appearing a certain way. But yeah, Nick, I think your example of having an extra $1 million of wealth down the track is a great way to kind of start to drive a bit of different decision making.
I'm glad you brought retirement up, because one of the things that I can absolutely promise you, and this is from having a financial planning business, most of our clients, a good chunk of our clients are retirees. They don't care about cars when they get to retirement. What they look at is okay, I need this much money to buy a car. I know that's going to last me the next 10 years. But it's funny when that pot of money is that last pot of money, car is not even on the agenda. It's what do we need, so we can do our travel. Of course, there's situations where people want a caravan and they need an appropriate vehicle to do that. But cars come right down the agenda. And, I'm not... don't get me wrong. Like I know people are still going to buy and borrow for cars. Just have more of a think about it. And I think I'm a perfect example, because I would just work out what I wanted, work out that I could afford it, and then go and buy it. But what I've since realised is the impact it has keeping that car for a couple of more years. Anyone who understands, particularly if you're a business owner, if you've got a lease on a car, the way that most of those funding options work is you pay the interest up front on a lot of those products. So when you're rolling your car over every 3 years, in most circumstances, you've paid all the interest and the debt has really not moved very far. And then you go buy a new car and you go into the same amount of debt. The impact that you can have by hanging onto that car for 5 years, and as I said before, these days you can get 5-year warranties on cars, and it's not like it used to be. Cars are so, if you get the right car, very rarely do things go wrong these days. Not like they used to. They're easy to be fixed, and they just simply last longer. So a trade-off might be, well, I'm not going to pay cash for a car, but just think about holding your cars longer. Because then what happens is you really start, if you've got a business facility or a lease, you really start to eat into that principal after 3 years. So you'll get to the end of the 5 years where you are now with your balloon, Jason, you go, oh, geez, the car's probably actually worth more than the balloon. Versus where a lot of people get to, they want to upgrade it after 3 years and the car's worth less than what the loan is, and then they've got an issue. So if you don't want to pay cash, a couple of things I'd recommend you do. Just downgrade the car. So maybe don't spend what you thought you were going to, what you'd like to spend. Spend a little bit more. Hold it for the long term. Get through the balloon, and then quite often what you can do, which is what I did last time, which made a significant difference, is I went into the car with a hefty deposit. And that made a huge difference to my loan repayment. And this time around, I'm probably going to go into a car with a bigger deposit again. So if you're not paying cash and you want to borrow, go in with big deposits so the car repayment isn't killing you. you're paying a little bit more a month because you want a nice car, but it's not $2,000 a month,
But
which
it's
is
smart.
what we see.
It's smart, Nick. Like you come back to what's your leverage point that's feasible. And you go, like I said, even my car, I'm going to keep it for 10 years at least. It's because you get it serviced and it keeps running, right?
Yeah,
And decide what your leverage point is too, that you're comfortable. It might be 20%, might be 30%, but don't leverage to the hilt like some people do and continue to do.
And you know what the worst thing you can do, Marty, is, and we see this all the time, people that don't have the cash flows or the wealth to be driving nice cars. So what they do is they buy a 4-year-old European car that's got 80,000 Ks on it. So it's getting to the point where everything's about to go wrong. Instead of paying 250 grand like the owner did, they pay 180 or they pay 170, but they've bought a car where everything's about to go wrong. So what they should do is they should go and buy a brand new Toyota for 100 grand that's got a 5-year warranty on it, that they're never going to have an issue with that car and they can keep it for the longevity. Or if you want to buy a European car and you don't want to buy it brand new, go buy something with 20,000 Ks on it, but you might need to step down a model compared to the model that you wanted. Just be smart about it. But buying these European cars that are 4 or 5 years old because you want the European car, paying a premium with something that's got 100,000 Ks on it where things are about to go wrong, and then you're up for all these costs, versus going and buying a brand new Toyota with a 5-year warranty that's going to cost you zero, and you can probably hold it for 10 years. And that's when you really get ahead. And then maybe the next car, step up a model. The next car, go to the next one. As we get older, we're generally in better financial positions. We start to pay our debts down. Maybe just step up instead of doing what most people do. They buy the expensive one and then they end up stepping down because they learn the lesson, versus I'm going to buy a cheaper car, something that makes sense. And as I get more wealth, I'm going to buy better cars because it makes more sense.
And admittedly, I've never really looked at warranties and what's available these days, but quick best car warranty in Australia. Mitsubishi, 10 years, 200,000 K. Nissan, 10 years, 300,000 K. Hyundai and BYD, 8 years, 160,000 K. Not as good. But yeah, I mean, that's another great tip, that if you're thinking long-term and you want to kind of create wealth down the track, like make the long-term decision to invest in a decent car with a good warranty so that you aren't doing the roll it over every time. Pay it off, own it, and take care of it. I like it.
I'm probably a bad example, but Dad had a Hyundai, i30, and I reckon he paid 12, 13 grand for it at the time. He rolled it to $480,000 K, and he keeps telling me how good. Like the thing, when we actually went to trade it in at the end, the thing could barely get to the car dealer. It was in that poor nick. But that car, he goes, best investment. Only spent this much, brand new. And now that's the other extreme, right? But there's some fundamentals in there to that halfway point that is really, really fantastic.
One closing argument for people out there that are thinking about it, and are going to challenge this, but when would a car loan make sense? So, Marty, to your point, I've got to sell an asset to fund it, number one. Number two, I'd rather make a repayment and then use the money to go and fund an investment. Well, the reality is you're probably looking in the current market at 6% for a car loan at absolute best. I know you'll see some product providers, like Toyota, I think will advertise 3%. But if you're borrowing 3%, you're paying for it in the car. But if you're happy to pay 6% on a car loan, you've got to be happy that the asset or the whatever you're going to invest in is going to guarantee you 6% plus. Now, in today's environment, that'd be a real challenge. So maybe different in COVID when the interest rates were 2%. Different argument, but nowadays you're locking in a 6% return by saving 6%. So for me, that's the way to go.
Very good closing argument, Nick. I think, look, we'd love to hear your arguments too. If this has triggered you to think that we're trying to take your Ford Raptor off you or your fancy new Merc or whatever you're doing, love to hear in the comments. Jump on YouTube or hit us up to our email, hello@thenumbersgamepodcast.com.au. You can also connect with Nick, Jason, Marty on LinkedIn. We are very active on there, some of us more so than others, and that's why the great man Marty V is the most popular co-host on the show. We love him. He does cop it from us us, but he's the real MVP. So thank you again for tuning in. Do like, subscribe, get around. And if you haven't given us a 5-star review or rating yet, jump on to where you get your podcast from. Click the little 5-star button and tell us what you think. Until next time, though, Nick, this has been an absolute banger. Marty?
You're working hard. Are you trying to make the banks rich? Or are you looking after your future? Game over.
This podcast is for educational and informational purposes only. The conversations are of a general nature and do not qualify as financial or tax advice. We recommend before you make any financial decisions, you consult a licensed professional. Individuals on the podcast may hold positions in the companies discussed.